today, approximately 60 people from 6 continents. So we have a lot of time zones and a lot of diverse backgrounds and interests with us today. We do have a mix on the webinar today of both supervisors from countries around the world as well as credit union people at the national level, not necessarily credit unions themselves, but their associations at the national level. I'm pleased that last week myself and the Credit Union National Association presidents from Canada and Poland were able to sit with people from the Basel Committee in Basel, Switzerland, and have a chance to talk through and go through some of the presentations and proposals that they've put forward. And we're happy to have with us today Neil Esho, who's Senior Manager and a member of the Basel Committee Secretariat. Neil is originally from Australia, as you'll hear in a bit with his Aussie accent, and we're very happy and pleased to have him with us today. Before we do get started, for those of you that are new to webinars, I wanted to lay out a little bit about our process and what will follow here. As you're signed into the webinar, the first part of the webinar will be in a listening mode where you'll hear the presentation and see the presentation from Mr. Esho. And then later, towards the end, we'll allow for questions and answers. To ask a question, you'll see on your screen a menu bar, and towards the bottom a section that lists questions. You can expand on that section of the questioning by clicking on the cross in the left-hand corner of the questions section. In that area, to ask a question, if you'll type it into the lower hand box, we will see it here, and towards the end of the presentation today, we'll be facilitating the questions on to Mr. Esho. Without further ado, I also wanted to give an opportunity to Andy Papaura, who is chair of the steering committee of the International Credit Union Regulators Network and a supervisor himself from Ontario, Canada, to welcome us today. So, Andy, the floor is yours.
Thank you, Dave, and good morning, everyone, and welcome to this webinar. As you all know, the International Credit Union Regulators Network is an organization that we formed a number of years ago with the assistance of WACU to help put together a program where supervisors of credit unions from around the world can get together and share experiences and information and make the whole process of supervising credit unions a little easier, especially for those in developing nations where some of these aspects of supervision are not necessarily well thought through yet and being developed. So this is one of the things that we decided that we were going to do, is to do more webinars for supervisors and interested parties to make sure that we're all comfortable with some of the developments. As you know, the Basel Committee is working on a number of important elements, and then certainly capital and liquidity are those that touch on a national basis many credit unions around the world. So we're very pleased to bring this to you today, and thank Neil for taking the time to do this. And I'll pass it back to you, Dave, and we can hopefully connect at the end of the webinar. Thank you.
Great. Thank you so much, Andy, for those comments and setting the stage for us today. Without further ado, let me turn it over to Neil Esho from the Basel Committee.
Okay, thank you very much, Dave. Please let me know if you have any trouble hearing me. But if I don't hear from you, I'll assume everything is okay. Well, thanks for the invitation to give this presentation today. I think one thing I realized once I started going through all this was just how much we've actually done over the last year or year and a half. And I really had to try and refresh my mind on some of the things we've done, and it looks like it's going to keep going at least till the end of this year anyway. So I don't have access to the webinar, so I'll just tell Dave when I'm switching slides. So I'll go to slide 2. Firstly, I thought I would start by just giving you an overview of the Basel Committee's response to the crisis, and I've put it in. I guess it's in 3 categories. The first one relates to general risk management and supervision guidance that the committee has released in response to the financial crisis. And this really started immediately after the crisis, say in July 2008, and has continued up until very recently. The second element is the reform of the capital framework.
Muted.
Two main elements to what the committee has done here, 2 main releases. The first one was in July 2009, and the second one more recently in December. The first response to the capital requirement and the first sets of guidance were mainly focused on, I guess, fine-tuning the capital framework and responding to the issues that were, clearly at the centre of the crisis. So things like re-securitizations, capital requirements for the trading book, disclosure around re-securitization, securitization in general. So that was the first element, and that was done fairly quickly. The reforms that have come out, or the proposals that have come out in December, are much more wide-ranging and much more fundamental in nature. The third element, which was also released in December, is the framework for liquidity risk measurement standards and monitoring, and this is the first time there's ever been any framework for liquidity risk. The crisis has clearly shown that it's not, capital and liquidity equally is important, and so really this is like a Basel I for liquidity risk. So what I plan to do is really spend, the most of the time on the second and third point. I'm only going to very briefly go over the first one, and I just put it there just to give you a feel for what's already been done, but I'm not planning to go through any of the details on all the guidance that we've issued to date. So slide 3. In terms of what we have issued to date in terms of risk management and supervision guidance, I've listed some of the things that we have done. It's not exhaustive by any means. I just picked what I thought, not necessarily the most important, but some of the ones I was most familiar with, but also I think some of the more important ones. There's much more guidance that has been issued, but I just, the purpose of this is just to give you a feel for what's being done. For example, the first thing that was done was to update the principles that we already had for liquidity risk, management and supervision. A lot of the principles there were around trying to avoid excessive reliance on market liquidity, making sure that banks maintained sufficient cushions of liquid assets, that they did appropriate stress tests and had contingency funding plans, that they managed their intraday liquidity risk and collateral. In April 2009, we released some guidance around valuations, and valuations were clearly, in particular, the valuation and disclosure of complex products was clearly at the centre of the crisis. In having a look at how banks valued some of the complex instruments, there was clearly a very wide range of practices, some good, some not so good. There was often excessive reliance on rating agencies to get values. When liquidity dried up in some of these markets, many banks really didn't have models of their own to come up with valuations. There was switching between using observable prices that were really not liquid in the first place, but were based on primary issuance to some other method of valuation, which was all fairly ad hoc. So the guidance there is trying to essentially trying to improve valuation practices and really asking banks and forcing banks to to use a much wider range of approaches and not to rely, say, for example, on just taking the fact that a CDO has a AAA rating and inferring a price from that. We also released guidance around stress testing, which I think was another weakness that was made apparent during the crisis. I would say that the weaknesses here covered a range of aspects. Where stress testing was done, firstly, it was, attended to avoid severe scenarios. Essentially, senior management of the banks didn't want to hear about the results of more severe stress scenarios. There was lack of integration across the banks in terms of their stress tests. The methodologies were very much relying on, simple historical relationships, and which basically didn't include stress periods, so they were never going to get pick up potentially severe events. So the stress testing guidance there is focused for the banks, but also has some principles for supervisors. Then we come to the July 2009 enhancements to the Basel II framework. These cover both Pillar 2 and Pillar 3. They look at the issue of risk concentrations. One thing we observed during the crisis is that different departments within the Okay, I assume it's okay now. Had some bad interference there for a second. One thing we noticed during the crisis was that even within a single bank, that you had some departments within a bank reducing exposure to subprime, while other departments within the same bank were increasing exposure to subprime, and there was never an attempt or an ability to aggregate exposures across the whole banking institution. And so there wasn't a very good understanding of the concentrations to a particular risk across the different functions provided by a particular bank. There was obviously the issue of reputation risk, and banks seeing the need to take back on balance sheet exposures that were previously off balance sheet because of reputational reasons. So a lot of the recommendations there in terms of Pillar 2 and Pillar 3 focus on re-securitizations and improving that whole.
Unmuted.
More recently, we've issued some guidance on improving corporate governance. I guess some of the aspects of this, as you'd expect, they focus on the role of the board, including the role of the board in terms of improving and assessing the implementation of a bank's risk management strategy. There's more attention on oversight of the compensation system, which is obviously very topical, and the principles we tried to lay out a bit more detail in terms of what the FSB has laid out, trying to give a bit more flesh to those principles. And there's also more focus on the importance of independent risk management, and independent risk management with teeth. I think that's another lesson of the crisis, is that on occasions where risk managers did try and alert more senior management to potential problems, often they were ignored or overlooked. Okay, so that's all I want to say on the risk management and supervision side in terms of the guidance. As I said, there's more out there, and you could probably do a presentation on each one of those individually.
Neil, this is David. Before we continue on, I've gotten feedback from a couple people that they're having a little bit of trouble hearing you. So if you can maybe move your telephone closer to you and speak a little bit louder. Thank you.
Okay. All right.
And we've moved on to slide 4 now.
Now, is that better?
That's much better. Yes, significant.
Okay, yes, we've moved on to slide 4. So basically what I did just then was just give you a quick rundown of the guidance the committee has released in terms of risk management and supervision practices across a number of areas. What I want to focus on today is the reforms that the committee has made or has proposed in relation to the Basel II capital framework. And some people have started calling this Basel III. And I guess once you go through it, it does, given the significance of the changes, perhaps that's an appropriate change. In terms of the points I'll cover, the first one is risk coverage. So making sure that the capital framework covers all the risks, and this is done in a risk-based approach. And there are two elements to what the committee has done here. The first was released in July 2009, and the second in December 2009. In turn, the next issue is about the quality and level of capital. All the remaining issues were based on the December 2009 consultative document. Third issue is around addressing procyclicality. The next is the leverage ratio. I'll say a little bit about what the committee is doing in relation to systemically important banks, and then I'll also talk about the framework for liquidity risk. And I'll conclude by just giving you a brief summary of what's ongoing work in 2010. Okay, so slide 5. Firstly, in terms of risk coverage, as I said earlier, I think the immediate response in terms of the committee's response was to address the issues that were at the center of the crisis, and they related really to securitization, and in particular re-securitizations, so basically double securitizations, things like CDOs, and also revisions to the market risk framework. So a large part of what we observed in terms of the losses basically originated from these two sources. So what the committee did do was to put in place a system of higher capital charges for re-securitizations. There was new criteria, operational criteria for credit analysis, so much more stringent requirements in terms of what banks had to do in terms of assessing the risk of these securitization exposures in order for them to use the risk weights. And if they didn't meet, if the banks don't meet these criteria, then what happens is that essentially they get a capital deduction. And the purpose of these changes are to reduce the reliance on external ratings. Again, one of the lessons of the crisis was that people just took the ratings as given and tended to not do their own independent analysis. And the third element in terms of securitization relates around enhanced disclosure requirements. The second aspect of the July 2009 proposals relate to the market risk framework. And as I said, most of the losses we observed were in the trading book. The committee has done a number of things and is continuing to do more things in this area. But what we did do fairly quickly was introduce this notion of a stressed value at risk, covering a 12-month period. So basically, in addition to the existing value at risk charge, banks would be required to calculate a stressed VAR. The second major change that the committee has implemented is to require for re-securitizations that the banking book charges apply rather than the trading book charges. There is separate treatment for what's called correlation trading, but for other exposures the treatment is the same. And there is an expected, in terms of the capital impact for the institutions that are heavily involved in these activities, will be significant. I think in the order of 3 to 4 times increase on average, and obviously much higher for some, less for others. These enhancements are due to be implemented by the end of 2010. As I said, there's more work going on in this area. It really is targeted as an area where of significant weakness in the framework. So there's now currently undergoing a fundamental review of the whole market risk framework, looking at, for example, why you would have the distinction between the banking and the trading book, and what other criteria you could use to make a distinction, or what other approaches you could use, including whether you should have any distinction at all between the trading and the banking book. Okay, so that's the July 2009 package. I'm now moving to slide 6. Still on risk coverage, in terms of the December package we released, the main element here relates to counterparty credit risk, and this is probably the most complex part of the whole capital framework. So what I've got in 2 slides is not going to do that justice, but anyway, it'll give you a feel for what the committee has done. The first decision, well, let me take a step back. What this whole area is trying to do is come up with what is the exposure a bank has when it enters into certain, say, derivative contracts. So this whole framework is about working out exposure. And once you get that exposure, you then go through the usual process of working out the probability of default and the loss given default. But essentially what this whole part of the framework is about working out exposure to derivative type contracts. And the methodology that's been in place since Basel II is what's called this effective EPE, effective expected positive exposure. I don't know whoever came up with that, but it's the most horrible thing, but anyway, we live with it. And this is the measure used to come up with exposure at default for trading counterparties. So essentially what happens is that, let's say you've got a derivative contract, you're trying to work out potentially what could be the exposure to a counterparty on that contract, and you might simulate a whole bunch of different, curves. It might be interest rates, it might be foreign exchange, it might be a whole bunch of other things as to what your exposure could potentially be on this particular contract. So rather than using, standardized credit conversion factors that we had in the simpler approaches, this is really purely a modeling-based approach. So in terms of what's changed here, the first thing is that there's a proposal to use stress parameters, and this is really essentially copying what's been done on the trading book side to use stress VAR. So rather than just use sort of an average period, the proposal is to use stress parameters, and this is meant to make the whole framework less pro-cyclical, and it also ensures that you get a lot more capital as a result. There are proposals in here to get around the problem of general wrong-way risk. So this is the risk that basically your PD and your LGD go up at the same time. So one example of this is exposure to monoline insurers. Banks found in many cases that as the same time as the probability default of some institutions was increasing, their exposure to those institutions was also increasing at the same time. The next point talks about what's called a bond equivalent approach. And the idea here is that what we observed during the crisis is that a lot of the losses in this area related to valuation adjustments. So it wasn't as if you suddenly had a default of a counterparty. You have this in-between range where the credit quality deteriorates, but it doesn't jump all the way to default. So a lot of the losses actually experienced were related to what's called credit valuation adjustment losses. And the proposal in the committee's paper is to use what's called the bond equivalent approach, which essentially just means that instead you just assume your exposure to the counterparty is equivalent to a bond, and then you work out the variation in the value of that bond to get at the valuation adjustment. The next point is probably more of interest to some of the members on the call, and it's a proposal to apply a 1.25 multiplier to asset value correlations of financial firms. And the idea here is to address the higher level of interconnectedness in the financial sector. We've done a lot of work looking at how highly the correlation among financial firms as opposed to non-financial firms, and we think we're fairly comfortable with saying that in a relative sense, clearly financial firms are more correlated than non-financial firms, And so the proposal is to apply this multiplier, which essentially would have the effect of coming up with a new risk curve for financial firms and would increase the capital required for exposures to financial firms. The proposal would apply to regulated counterparties with assets greater than $25 billion and unregulated counterparties as well, though in the proposal we haven't actually defined what an unregulated counterparty is. Okay, slide 7. Slide 7 expands a bit more on the counterparty credit risk proposals. Maybe I'll just go through this quickly. Essentially, what the first 2 points talk about is increasing the margin period of risk, and also increase to 20 days for all netting sets that have over 5,000 trades. So if the netting set is complex, or if there have been a number of material disputes, then the bank has to calculate its capital requirements using a longer margin period, and the effect of that is essentially to require more capital. The committee is also providing input to the Committee on the Payments and Settlement System and IOSCO on recommendations for central counterparties, so that we have one international set of rules covering central counterparties. And we've also recently issued some guidance to try and improve the backtesting of counterparty credit risk. This is an area that before the crisis was really quite poor. It's partly because it's so difficult to do. A lot of these instruments have very long time horizons, so it becomes very difficult to backtest the models to determine if they're actually working okay. If you're looking at a 30-year time horizon, it's quite difficult to backtest. Okay, let me move now on to the definition of capital. So in terms of the December 2009 proposals, the main aspect of risk coverage was really the counterparty credit risk rules. Let me now talk about definition of capital, and firstly a bit of background. We have the Basel I definition, and it was revised in 1996 by the Market Risk Amendment, which essentially brought in T3. This was then revised in 1998 by what's called the Sydney Agreement, and this is in a press release in 1998, which covered innovative T1. The Basel Committee had committed to review, or the Basel II, when it was released, had committed to review the definition of capital, and this review had already began in December 2006, so well before the start of the crisis. So when we were entering the crisis, we had pretty much already done a survey of how the definition of capital rules were being applied across different jurisdictions. Okay. In terms of the current limits, this is all pretty straightforward. Total capital must exceed 8% of risk-weighted assets. T2 cannot exceed T1. And the predominant, in brackets, form of T1 must be common equity. And there was, what we found, that there was a wide variation of interpretations of what predominant meant, ranging from 50.01 to higher. Okay. What did we find from doing the work on the survey of what individual jurisdictions were doing? Sorry, I'm up to slide 10 now. The problems with the existing definition. The first one is that common equity can be as low as just 2% of risk-weighted assets. And if you then think that, well, you know, it's not uncommon to have risk-weighted assets that are 50% of total assets or even lower, then you're ending up with a minimum capital standard that is, you know, just 1%, you know, of non-risk-weighted assets, which is just, you know, woefully inadequate. The second conclusion was that often deductions were not applied to common equity, so they were applied to the T1 capital base, and this could lead to the sort of perverse outcome that you could end up with tangible common equity actually being 0 or even negative, but still meeting the regulatory requirements. Third point was there was no harmonized list of deductions or filters. And fourthly, this is an area where transparency and disclosure was particularly weak. So based on those 4 points, the committee then set about, coming up with proposals to improve each of those points. I'm now on to slide 11. And the mandate for this really came from the group of central bank governors and heads of supervision in their press release of 6 September 2009. This is the group to which the Basel Committee reports, so that's part of our governance structure. And in terms of harmonising the definition of capital, they said in this press release that we should raise the quality, consistency and transparency of the Tier 1 capital base. The predominant form of Tier 1 capital must be common shares and retained earnings. Appropriate principles will be developed for non-joint stock companies to ensure they hold comparable levels of high-quality Tier 1 capital. Moreover, deductions and prudential filters will be harmonised internationally and generally applied at the level of common equity or its equivalent in the case of non-joint stock companies. Finally, all components of the capital base will be fully disclosed. So with that as sort of the overriding guidance, the definition of capital group then developed the details that are actually in the December paper. Okay, slide 12. In terms of the actual proposal on the definition of capital, the predominant form of Tier 1 is essentially common shares for joint stock banks. The equivalent instrument for non-joint stock banks, e.g. mutuals and cooperatives, plus retained earnings, less a prescribed list of deductions and filters. Both the common shares and the equivalent instruments for non-joint stock banks must meet a set of principles to ensure their quality, and all components of regulatory capital must be disclosed and reconciled to the reported accounts. I guess the difference between this proposal and what we had previously in relation to non-joint stock companies, I would say, is that what we are doing here is trying to give a sense in terms of the criteria that we have outlaid, a sense of the ideal that we're aiming for. So we've taken the features of what is common equity. We've outlined those features, and based on those features, that's the ideal we're aiming for in terms of other instruments that non-joint stock firms could issue. I guess the other thing I would say is that I guess this goes a step further than what we had previously, because the Sydney Agreement only referred to voting common and didn't say anything about mutuals or cooperatives. And the last point on that slide, which I've already mentioned, talks about the disclosure. Definitely a very weak aspect prior to the crisis. It's very difficult getting comparable, very basic comparable common equity measures across firms where you have the same sorts of deductions. And what we're proposing to do is come up with disclosure requirements that will address that. Okay, slide 13. What are the deductions to common equity? Some of them straightforward, some less so, but we've just listed them here. Goodwill and other intangibles, deferred tax assets, investments in own shares, investments in the common stock of certain banking, financial and insurance entities which are outside the scope of regulatory consolidation, shortfall of the stock of provisions to expected losses. So this is if you're at a advanced or an IRB bank, internal ratings-based approach bank. Cumulative gains and losses on cash flow hedge reserves related to the hedging of projected cash flows which are not recognised on the balance sheet. Gains and losses due to changes in own credit risk on fair valued financial liabilities and defined benefit pension fund assets. There are certain limited exemptions which may apply, these are being considered as part of the committee's impact assessment. In terms of other elements of the definition of capital, so slide 14. So we've got the common equity component, which has been the focus of what I've just covered. In terms of the other elements of Tier 1 capital, these will be strengthened, and essentially the criteria here is that in order to count as Tier 1, the instruments must be loss absorbing on a going concern basis. Okay, so the instrument must be able to take a loss and the bank continue as a going concern, and innovative features such as step-ups will be phased out. So as one fairly senior supervisor said, this is not the area to play around with innovation. Tier 2 will be simplified. There's no subcategories. The general principle covering Tier 2 is that the instrument should be loss absorbing on a gone concern basis, and there's a single set of criteria which are laid out in the document covering what these instruments, the features these instruments should have, and Tier 3 will be abolished. Okay, slide 15. Moving on now to the issue of pro-cyclicality and some of the measures that the committee has put in place to try and address pro-cyclicality. Firstly, I would say that one of the side effects of having a risk-sensitive capital framework is that it inherently has an element of cyclicality, and that just simply cannot be avoided. However, when we designed Basel II, we did introduce a number of elements to try and counter pro-cyclicality. For example, we have floors on loss given default. We have the downturn loss given default. We have the through the cycle rating approaches. So these are all attempts to try and limit the pro-cyclicality of the capital framework. Some of the new things we've introduced in terms of the trading book, which has a stressed value at risk, and the counterparty credit risk, which requires the use of stressed inputs, will also go some way to reducing pro-cyclicality. So that's in terms of what's already been done or what's already been proposed. There's a more general issue around building capital buffers in good times that are available in stress, and I think in principle everybody tends to agree that this is a good idea to build buffers that you can run down in stress. It actually turns out very difficult to do in practice and to be confident that it would work. So it's not so straightforward. In terms of what the committee has proposed, there's two elements to it. There's what we call a capital conservation buffer, which essentially allows banks to use, which requires banks to build up buffers, but they can be used subject to certain restrictions on distributions, including dividends and bonus payments. And there's another element which has a more sort of macro flavor to it, which is trying to build up buffers when credit growth or macro conditions, or there's asset price bubbles or something like that, and that these can only be drawn down when those conditions start to deteriorate. Okay, an important aspect of both of these is that in order for this thing to work, the buffers have to be able to be used in stress periods, and I guess there's two parts to that. The first part is what we can control in terms of regulators allowing the buffers to be used, and the second part is what we cannot control, and that is what the market will require once you move into stress periods. Moving on to slide 16, some of the practical steps that are currently being considered to address pro-cyclicality. So the first one I've already mentioned is the use of stressed value at risk for the trading book and counterparty credit risk, the through the cycle PDs. One thing I didn't mention was the whole area of accounting and moving from an incurred loss accounting model to an expected loss model. So there's been lots and lots of ongoing discussions with the accounting industry to move to a model that's based on expected losses. So the committee sort of put forward its view on what the features of an expected loss model should be, and it's continuing to try and push its approach with the accounting standard setters. The capital conservation I spoke about briefly, and just to repeat, the basic idea here is that banks will build these buffers when they have the capacity to do so. So it's essentially based on their earnings, and they can draw down on these buffers when they need to, that is when they're making losses. One of the motivations for this is an observation that even during periods of stress, banks are distributing earnings, and what we view here is that essentially there's a collective action problem, that the last thing most banks want to do is cut dividends, and even when they're in periods of stress and should be conserving capital, they tend to want to keep making those dividend payments because of the worry that of the signaling effects of cutting back on those dividends. And essentially what the capital conservation proposal is designed to do is to try and force the cut in dividends when a bank is in trouble and it really does need to conserve its capital. The bank can still continue to make loans, so that's the element that gets at the pro-cyclicality. You can continue to use your capital to make new loans, but you can't continue to make distributions based on dividends and other discretionary bonuses. Okay, slide 17. This gives a bit more detail about the capital conservation buffer. There's a buffer range, so whatever the minimum capital requirement is, so currently it's 8%, there would be a range established above that, so 8 plus X%. Whenever a bank starts nearing the minimum, its distributions would be constrained. So essentially what, the basic argument is, as you get nearer to your minimum capital requirements, you should start cutting back on distributions. If you're well above your minimum capital requirements, then there are no constraints imposed. Okay, so by design, the constraints imposed on banks with capital near the top of the range would be minimal. Okay, slide 18 provides a table which provides a bit more detail as to how this would work. This is not a calibration, it's purely just an illustration. So the left-hand column essentially shows you the position of the bank relative to its minimum, and then the right-hand column shows you the minimum capital conservation ratio. Okay, so the amount by which a bank's capital exceeds the minimum requirement in terms of a percentage of the size of the conservation range. So if a bank has capital requirements that exceed the conservation range, so greater than 100%, then there is 0. So I'm looking at the last row. There is no constraint on its distributions. Once it starts cutting into that range, so if it holds capital in the 75 to 100% range of what this additional buffer should be, then it has to conserve at least 40% of its earnings, and so on as it gets closer. So in the very first row, the less than 25%, as it gets closer to its minimum capital requirements, the requirement is for 100% of earnings retention. Okay, so that's sort of the basic idea. As I said, there's no calibration in that table. It's just meant to provide an illustration. Okay, slide 19. Now moving on to the leverage ratio. Here we're basically talking about introducing a simple backstop measure to the risk-based measure. It's meant to act as a floor to the risk-based measure, not to replace the risk-based measure. And essentially, we're just looking at a measure of capital to assets, but also including some account of off-balance sheet exposures. The aim in designing this, which is hasn't been easy, was to come up with something simple, transparent, and also internationally consistent or applicable. And that's where it gets difficult, in large part due to differences in accounting standards across jurisdictions. Some of the practical issues, how to treat off-balance sheet exposures and derivatives. There's sort of a general agreement that if you rely only on looking at what's on balance sheet in terms of the leverage ratio, then you're creating incentives to shift basically stuff off the balance sheet. So when these instruments are basically doing that, there's a strong argument for also including them in the leverage measure. There is the issue of accounting differences across jurisdictions, which can make the size of the balance sheet look very different across banks, in large part due to netting of derivatives and repos. Depending on how much netting is allowed in the accounting standards, you can get vastly different measures of the size of the balance sheet that banks report. And then there's the third issue of how does this interact with the risk-based measure. We don't see it as replacing the risk-based measure, but we do see it as being sort of a basic floor under which nobody should be, essentially. No matter how safe your assets or how good your risk management, there's a basic level of leverage below which you shouldn't go. Slide 20 gives you a summary of the leverage ratio proposal. Essentially, there's two elements. There's a capital measure and a total exposure measure, and this just outlines what we call a baseline proposal and some additional alternative policy proposals that we're considering as part of the quantitative impact study. In terms of the definition of capital, essentially we'll just take what the committee decides in terms of the definition of capital. There'll be no new definition for the leverage ratio. It'll just be a matter of choosing whether it's a T1 capital measure at the predominant form of T1 or total regulatory capital. So there's no new measure for the leverage ratio. It's just a matter of choosing which one should be used. There's a strong preference at present to use T1 or the predominant form rather than total regulatory capital. In terms of the total exposure measure, firstly, exposure measures follow the accounting treatment, so it's net of provisions and any other valuation adjustments. There's an issue of how you treat highly liquid assets. The issue here is that we have a liquidity requirement that is encouraging banks to hold highly liquid assets, and then if you also include them in the leverage ratio proposal, then some people argue that essentially you're punishing them for holding liquid assets. So there's the baseline proposal is to include all cash and cash-like instruments, not to make any exclusions or exemptions for that, on the basis that once you start excluding one thing, it becomes difficult to draw the line on where you stop. And so what we're doing as part of the quantitative impact study is assessing how significant that would be, and there's an alternative option to look at excluding liquid assets as defined in the liquidity risk proposals. In terms of including off-balance sheet items, the proposal, again trying to keep it simple, is just to apply 100% credit conversion factor, but also to include written credit derivatives in this treatment. The idea for including written credit derivatives is that basically they're the same. They provide the same exposure as as providing a guarantee or a loan, so they should be treated the same way, and if you don't treat them the same way, then you'll just provide an incentive to shift to that sort of activity over others. The alternative is to apply a lower credit conversion factor to unconditionally cancelable commitments, i.e. credit cards, or to use the Basel II standardized credit conversion factors. In terms of risk mitigation and on-balance sheet netting, so there's no accounting for physical or financial collateral. If anything is deducted from capital, then it's also deducted from the exposure measure. In terms of securitization, the baseline proposal is to use the accounting data or the accounting approach. So if it's on balance sheet, then it's included. In terms of how to include derivatives, this is excluding credit derivatives, but all other derivatives, there are two options being assessed. The issue here is that when you account for a derivative, you have the on-balance sheet amount, which is the fair value, but then you also have this potential exposure. And the issue is whether you try and include something to capture this potential exposure, which we do using the Basel II framework. So we've got one option is just to ignore potential exposure and argue that it's captured in the risk-based framework, or the alternative is to use the current exposure method. And then there's also the issue of whether you allow netting or not, either accounting or regulatory netting. In terms of repurchase agreements and securities financing, the baseline proposal, so here we're trying to get, in terms of both the derivatives and the repos, this is where the big issue of accounting consistency comes into it. And in order to be consistent, the only way to do it is to either allow no netting, so everybody's on the same basis, or to apply a common set of regulatory netting proposals which do exist in Basel II. So either of those approaches would get around the problem of relying on accounting standards which differ across jurisdictions. Obviously, if you applied no netting, then that exposure amount is going to be a lot larger than if you apply the Basel II netting rules. Okay, slide 21, systemically important banks. This is an area where we didn't really say a lot about, I think, in the December proposals. I think there's a strong rationale for doing something specific for systemically important banks, and obviously it's received a lot of attention over the past few months in particular. I guess the rationale for that is that I guess you could put it down to two things: the experience of the crisis. We saw that the failure of systemically important banks transmitted negative shocks across the systems. The policy options that were available to supervisors and others were limited. There was, as a result, public sector intervention to restore financial stability was necessary, and it was done on a massive scale. And the result of this was an increase in moral hazard, and we need to effectively reduce the likelihood and cost of such intervention in the future. That's sort of a rationale based on what we've experienced. You could also base a rationale on externalities, which is that when these firms fail, or when they just become impaired, they can do significant harm to other parts of the financial system and the real economy. And it might be optimal or rational for individual firms in maximizing their own benefit to take actions that are suboptimal at a system-wide level, and this can have the effect of increasing systemic risk. So I think the rationale for treating systemically important banks exists, and the objective of the work here is to try and do two things, is to reduce the probability of the event, so the probability of the failure of a systemically important bank, through, for example, a capital surcharge. And the second area of policy proposal centered around trying to reduce the impact. It's like the LGD, but it's the LGD for the system, not for the bondholders. So the impact on the system if failure occurs. And you can try and improve those things through better resolution mechanisms and greater use of central counterparties. So that's what we're working on. I'd say a key challenge here is how do you measure systemic importance. The FSB, BIS, and IMF did produce a paper covering 3 aspects of systemic importance, which is size, which we can measure reasonably well, substitutability of firms, which we can't really measure at all. In a quantitative sense, very difficult. And then there's interconnectedness of firms, which can also cause them to be systemically important. Again, we're finding that's quite difficult to measure, but it's a bit more promising than measuring the lack of substitutability. But the general direction here is to try and do something that gets at those 3 aspects of systemic importance. Okay, slide 22, liquidity. This slide covers a bit of what I covered earlier in terms of the sound practices. We did release the updated sound practices, and these just built off what we'd released in 2000. I guess one of the obvious things there was that the principles we'd released previously were not really adequately implemented, and one of the things that will be happening later this year is that the committee will be following up on the implementation of the liquidity principles, starting with the implementation by supervisors and then following up with the implementation by banks. Okay, so the rest of that slide just sort of gives a rundown of what happened during the crisis. So let me go to slide 23, which is the actual proposals. The committee's proposed two global liquidity standards. We have a stressed liquidity coverage ratio, or the LCR, and there is a longer-term structural ratio, or the net stable funding ratio. The purpose of the stressed liquidity coverage ratio is to promote short-term resilience by requiring banks to hold sufficiently high-quality liquid assets, and these high-quality liquid assets should be in sufficient volume to allow a bank to survive an acute stress period lasting for 1 month. So essentially, you need to hold high-quality liquid assets to cover outflows that may occur in a 30-day during a 30-day stress period. So if you look at the ratio, it's the stock of high-quality liquid assets over the net cash outflows over this stress period must be greater than 100%. In terms of some of the issues, there's the issue around how you define liquid assets. The baseline that the committee has is a fairly narrow definition. There's also an alternative which is being assessed through the quantitative impact study, looking around a more broader definition of liquid assets. In terms of the stress scenario, it includes things like what happens when there's a 3-notch downgrade in the institution's credit rating, the loss of wholesale funding, the bringing back onto the balance sheet of additional items due to avoiding reputational risk, unscheduled draws on committed lines, some retail deposit runoff, and the need to fund balance sheet growth to mitigate reputational risk type issues. Slide 24 gives a bit more detail around the characteristics of high-quality liquid assets, and essentially it says liquid assets should be easily and immediately converted into cash at little or no loss of value. Liquidity of an asset depends on the underlying stress scenario, the volume to be monetized, and the time frame considered. Certain assets are more likely to generate funds without large fire sales in times of stress. So just because you have certain assets may be highly liquid, such as equities, you don't want those assets included, because they're also the types of assets that could have large fire sales in times of stress. So you want an asset that's stable during times of stress, and these types of assets are often eligible for collateral at central banks. In terms of the fundamental characteristics of these instruments, they should have low credit and market risk. They should be easy to value. There's not a complex CDO that nobody really knows how to value. They shouldn't be correlated with risky assets. They should be listed on a developed and recognized exchange. In terms of the market characteristics, the market for these instruments should be active and sizable. There should be a presence of committed market makers, low market concentration, and there's a flight to quality in terms of historically the market has moved into these types of assets during a crisis. Slide 25 then gives you the definition of the liquid assets to be used. It's essentially cash, central bank reserves to the extent they can be drawn down on in times of stress, marketable securities issued or guaranteed by sovereigns, central banks, non-central bank government, public sector entities, the BIS, the IMF, EC or multilateral development banks, government or central bank debt issued in domestic currencies by the country where liquidity risk is being managed. So that's the narrow definition of liquid assets, which is the baseline proposal that the committee is consulting on. Slide 26 then lists some additional assets that are being considered in the broader definition. So the committee is gathering data as part of its QIS on corporate bonds and covered bonds to analyse whether such instruments should be included in the broader definition of liquid assets. However, if these instruments were to be included, then they would have to be included with substantial haircuts. And there are also a whole bunch of other criteria which is provided in the consultative document. Okay, slide 27 now. In terms of the longer-term liquidity requirement, this is the net stable funding ratio. And whereas the liquidity coverage ratio, it focuses on a 1-year time horizon, the net stable funding ratio focuses on the liquidity coverage ratio focuses on a 30-day time horizon. The net stable funding ratio focuses on a 1-year time horizon, and the purpose is to try and encourage banks to have resilience over this longer period, and also encourage them to restructure their balance sheet so that there are more stable sources of funding. Essentially how this works is that there's a relationship between the available amount of stable funds, or ASF, and that's related to the amount of required stable funding. And essentially what should be available needs to be greater than what is required. So it's got to be greater than 100%. So what's available is things like capital, liabilities which have a maturity greater than a year, and certain percentages of deposits. And in terms of what's required, each of the assets in the balance sheet held by a bank are multiplied by a specific factor. So the required stable funding factor, and essentially the more liquid the asset, the lower the factor. So if you have a liquid asset, then you don't need as much stable funding to cover it. And then if you go to the next slide, 28, that just provides a summary of the net stable funding ratio. So your stable funding must be greater than your available amount of stable funding must be greater than what's required. So if you go through some of those items, so for example, if you look at the top row, in terms of what's available, you can count all T1 and T2 instruments. You can count 50% of wholesale funding provided by non-financial corporate customers. So you essentially just take those balance sheet amounts and apply them by those factors. And on the required stable funding side, obviously if you're holding cash, then you don't require stable funding, so that's 0. As you go down the categories to loans, then you require, say, 100% stable funding factor. Okay, so that's sort of a brief, fairly quick rundown of what the committee has released. covering both the July and the December packages. And I'll just conclude by talking a little bit about what's on the agenda for 2010, and then we can open it up for questions. In terms of what's happening in 2010, the committee released a press release, and there was a G20 statement out of the Pittsburgh summit, which said that we would come up with fully calibrated standards by the end of 2010, and that's what they said that we'll do, so that's what we're going to do. We have a quantitative impact study or quantitative impact assessment underway, and this is in terms of all those proposals we've outlined. We're collecting data from banks from all the committee member countries. I'm not sure how many banks are actually involved, but it's a lot of banks, and it's an incredibly detailed data collection exercise. You can actually find the spreadsheet and the templates on the BIS website if you're interested. So we're in the process of collecting that data. Once we collect all that data, we'll know what the impact of these proposals are. So we'll know, starting from where we are, if we implement each of these reforms, we'll know how much extra capital, how much extra liquidity will be in the system. But we're going to supplement that with an additional sort of top-down calibration exercise, because this sort of bottom-up, policy-by-policy, bank-by-bank assessment tells you how much capital and liquidity will increase, but it won't tell you whether that's overdone or whether it's okay or whether it's insufficient. It just tells you what the change is. So in addition to this bottom-up exercise, we have a top-down calibration exercise going on, which will consider all the elements of the proposals in an integrated way to come up with an assessment of what we think capital needs to be in the system to safeguard the resilience of the banking system and to promote long-term stable credit provision and economic growth. So I don't think we've ever done this before. In Basel I, we had the 8% minimum capital requirement. Not exactly sure how we arrived at that, but Basel II basically said, well, the aim there is to maintain capital in the system, so not to have any change. But what we're doing this time, I think for the first time, is really going through and looking at a whole bunch of different types of analyses,
Unmuted.
bank analyses to more macro type analyses, to try and work out, well, what do we think is the optimal level of capital that we should have in the system. And the last slide, slide 30. In terms of implementation, the standards will be phased in as conditions improve. In terms of what I just outlined, the aim is to implement by the end of 2012. The committee is still to discuss phase-in measures and grandfathering arrangements. Okay, I think that's enough for me.
Great.
Over to you, David.
Sure. Thank you so much, Neil, for the presentation and the details that you provided. We do have a couple of questions. I first wanted to go ahead and turn the microphone over to Derek So, who's with the Credit Union Regulatory Agency in Singapore and the registrar's office there. So, Derek, if you want to go forward with your question.
He's unmuted.
Derek?
He doesn't have a microphone. He just said.
It sounds like you don't have a microphone. I see as a chat there, so I'll ask your question for you. Neil, when you were talking about the short-term liquidity funding needs, Derek had the question as to whether or not deposits that credit unions had in other credit unions would be counted as part of liquid assets?
In terms of interbank, no. I think the proposal is no. So interbank deposits and loans, basically no. They wouldn't count, no.
Okay. And how about in some jurisdictions, in fact in many jurisdictions, credit unions have a second tier entity that is kind of a wholesale credit union, if you will, owned by the primary level credit unions, and they oftentimes manage their liquidity through that entity because it's got more expertise than many of the small credit unions. So would the same answer be for that type of entity as well?
Are you talking like I'm familiar with the Australian arrangements. Are you talking like the Cuscal arrangement?
That's correct.
I think that would basically be up to APRA as to how they treated that.
Okay.
Yeah.
Great. And then we had two other questions. They were similar, actually. One from Michael Edwards in the United States with the Credit Union National Association, and Andy Papauer had a question somewhat similar to this earlier regarding the time frame for which you see the new standards coming forward. You touched on that a little bit at the end, but maybe if you have information on expected time frames in the United States or Canada when you think it could be implemented there.
Yeah, when it comes to individual countries, I really can't say much, but sort of our baseline is end 2012. But part of the assessment work we're doing is looking at what's the impact in terms of transition over different time periods. What's the impact in terms of the impact on banks? What's the impact in terms of the impact on the macroeconomy over 2012 or a longer transition period? So that's basically part of this top-down assessment that we're doing.
Okay. Another question that we have is regarding the impact studies that you mentioned, that there are several institutions participating in the impact studies. Is that through their regulators or the institutions themselves? So that was one part of the question. And the other part of that question is whether or not there's a range of size of institutions participating. So do you have smaller financial institutions also participating in the quantitative impact assessment?
Yes, to answer the second part, we do. There's a range from the biggest down to much smaller financial institutions. So we do have that size range. In terms of how the institutions participate, it is via their national supervisor. So we develop the templates, the supervisors then distribute them to institutions in their jurisdiction, and then the supervisors send them to Basel, and all the information is collated here.
Okay. And how will the results of the impact assessment be shared? I know that going back to Basel II, there was, I think, a fair amount of information shared about what the assessments were showing. And is that same process being anticipated for this round?
I expect so. Yeah, I think given the profile of the whole process, and there will be a public release of the impact.
Okay.
Similar to what's been done before.
A couple other questions here. One relates back to, I think, on slide 12 when there was a discussion on non-joint stock companies and their Tier 1 capital. The question is regarding in many cooperatives, there's membership shares that, depending on the jurisdiction, there can be a range of ways in which these are treated. But in some jurisdictions, these shares, while they're withdrawable, they are only withdrawable if certain conditions first apply, and therefore they're kind of they are at-risk capital. So, for example, the shares can be withdrawn if the institution doesn't have any losses in the previous year, or assuming that its capital ratio is above X percentage, they can be withdrawn. So do you know if those kinds of circumstances are being looked at as to whether or not these would qualify as common, what was being called common equity equivalent for non-joint stock companies?
Yeah, I think it's definitely something that's being looked at, but I would say not really resolved as yet.
Okay.
Yeah, so you're talking about basically when you join a credit union, you'll typically pay, I don't know, like a $2 contribution, which you can take out when you leave. Is that the sort of thing you're talking about?
Yes, and in some jurisdictions, they may allow additional membership shares beyond that. So there may be that minimum $2. In some countries, it could be much higher than that. And also there are other places where there's a minimum of, the $2, if you will, but there's additional membership shares that you can purchase as well up to certain levels.
Right.
But again, they have loss absorption capabilities as long as the institution's capital, they have loss absorption capabilities if the institution's capital falls below X percentage, or if there are losses in the previous year. So there are waiting periods on withdrawals.
Yeah. No, I think the difficulty here is the wide range across jurisdictions. So coming up with one proposal might be quite difficult. So it's a matter of how we accommodate some of these things without watering down the substance of what we're trying to achieve for the joint stock companies.
Okay. Another question that we have is regarding expected loss provisioning. So you described that a bit as to what's being looked at. Can you go into any further detail? We know that in some jurisdictions this is in place already, and at times it can be a simple percentage of a total gross loan portfolio. You've got to provide for the substandard losses at date ranges, and 1% or X percent of your total gross loan portfolio. Can you explain a bit more what's being looked at regarding expected loss provisioning?
Essentially, the IASB has got a proposal out, which looks quite complicated. And so what the committee is trying to do is develop some sort of principles that get at expected loss provisioning that would essentially include both quantitative, say, historical factors, but also some sort of qualitative judgment on top of that. Perhaps not as simple as what you just outlined, but not too much more complicated.
Okay.
Yeah.
So it may be more principle based on which supervisors then go ahead and apply in their jurisdictions.
Well, I think it would be principles. Well, the aim is to do this all through the accounting. Okay. So it would not be something that the committee issues in addition to the ISB. The aim is to have whatever the ISB does fit in with what we're trying to achieve. So they do have a proposal out, and we've I'm not sure if we've commented yet, or we're commenting on that proposal, and just trying to get something that sort of gets at the spirit of expected loss, that takes into account quantitative evidence that you have, qualitative evidence that you need to take into account. So for example, if you were doing subprime before the crisis and you were just looking at historical data, you may have very low or reasonably low loss rates, but the qualitative overlay might suggest you should be making much higher provisions. But the ISB approach is also called an expected loss approach, but it looks, from what I've seen, I'm an accountant, it looks a bit more detailed in terms of the information it would require banks to get. I think you need to somehow forecast your future cash flows, work out the ones which will default and the ones which won't, and then present value all those back. But what we're proposing, I think, is something much simpler.
Okay. Yeah.
But it should all work through the accounting. So.
Okay. What you just described, thinking about many smaller credit unions around the globe, probably would be something that would be difficult for them to, forecast, future values or present values of expected loan flows. So.
Hopefully it doesn't go that way.
Yeah. And then, of course, having to do that on some kind of rolling basis as well.
Right.
So, on the leverage ratio, this may be outside of the realm of kind of where the committee can go at this point, but any sense as to what's being looked at? I know that in some jurisdictions, the states being one of them, I think there's a 4% leverage ratio in addition to the 8% risk-weighted. Any sense as to, the range that might be? Is it, going to be related to Tier 1 capital and the percentage that needs to be?
Yeah, I think the actual number is not, no, because it really is going to depend on what ends up being both the denominator and the numerator. So it's really hard to say. So I think the best way to think about it is in terms of what the objective is relative to the risk-based number. So it's meant to be a safeguard, a floor. It shouldn't be binding, for most banks most of the time. So that's what will drive the calibration. But you can't really pick a number until you know exactly is it going to be Tier 1, total capital, and which of some of the policy options will actually be accepted.
Okay. Are there any other questions that we have out there from participants at this point? If not, I'd like to turn it over to Andy Papaura to see, Andy, if you have any closing comments that you'd like to make.
Well, thanks, David. And first of all, I'd like to thank Neil for an excellent presentation. I think we all found it extremely interesting, and wish you well with the rest of the work that the Basel Committee has put on your shoulders, because I know that there's a lot of things going on, Neil, that you need to factor in. One of the things that strikes me as a credit union regulator is that over the last few years, some of the things that credit unions have, as basic principles, have followed in terms of prudent risk management and so on, have stood us well. And sometimes simple rules are probably the best rules because everybody can understand them and adhere to them. So given the complexity of large international banks that the Basel Committee is working with, I think we as regulators of credit unions are a bit fortunate in the sense that we don't have the complexities that perhaps large banks have. I also, before we break off, wanted to make sure that everyone is aware of the Regulators Roundtable, which will be held in Las Vegas in concurrent with the, or just post the WalkU conference. It'll be on July the 15th and 16th in Las Vegas. And we invite all the regulators that are attending today's webinar to join us for that. And I think we're going to have a very interesting couple of days to talk about these kinds of issues. And it'll be a great opportunity for us to meet in person. But in the meantime, I wanted to thank Dave again for organizing this and for Neil for doing an excellent job on this presentation. Thank you very much. Back to you, Dave.
Great. Thank you, Andy. And on behalf of the World Council and the Regulators Network, Neil, thank you so much for spending time with us and for sharing with us what the committee has done and the work that it sees ahead. So again, thank you so much for taking some time today to keep us up to date.
Okay, thank you very much, David.
Okay. And we will be sending out the copy of the presentation to those that participated in the webinar today. So thank you so much. Bye-bye.
Bye.
Okay. Anything we missed? He pitched it, I think, at a way too detailed level of, you know, what's applicable for